What if I told you that the real puppet master behind today's financial market died nearly 100 years ago? That your mortgage, your retirement fund, and even your crypto portfolio are still dancing to the tune of a ghost? The Great Depression wasn't just a financial crash, it was a reset, a rewriting of the rules, and its fingerprints are still all over Wall Street today. The Great Depression, starting in 1929, was a catastrophic economic downturn that lasted a decade. It led to massive unemployment, widespread poverty, and significant changes in financial regulations. The lessons learned from that era continue to shape our financial systems and policies today. Welcome to episode 8 of the Hidden History of Money series, where we cover the topic of the Great Depression and how it still shapes Wall Street today. Please remember to like, share and subscribe to our Finance Arcana YouTube channel if you like our content. Stick with us till the end of this episode and we'll uncover a money-making tip from the 1930s that's still crushing modern benchmarks. And almost no one talks about it. This strategy, rooted in the depths of the Great Depression, involves a unique approach to value investing. By focusing on undervalued stocks with strong fundamentals, it has stood the test of time. It's the 1920s. America is booming. The economy is growing at an unprecedented rate. The stock market is the new religion. People are flocking to Wall Street. People are borrowing money to buy stocks. Margin trading becomes mainstream. This means they're buying stocks with borrowed money. The Dow Jones, it triples in just a few years, reflecting the economic boom. Everyone, taxi drivers, school teachers, even shoeshine boys, are placing bets. The stock market fever grips the nation. But underneath the glittering surface, the economy is rotting. The 1920s saw a boom in consumerism, but it was built on shaky ground. Income inequality is at historic highs. Farming collapses. Banks are undercapitalized. Stock market speculation runs rampant. Sound familiar? October 1929. The fantasy ends. Stock prices plunge. In just 2 days, $30 billion evaporates. That's over $500 billion today. The aftermath is immediate and devastating. Banks fail, businesses collapse, and millions lose their jobs. The Great Depression begins. Banks collapse, businesses go bust, families lose their life savings overnight to 25% unemployment. People who were millionaires are now selling apples on street corners, bread lines stretch for blocks, and the government paralyzed until a new hero steps up. Franklin D. Roosevelt promises a New Deal. Franklin D. Roosevelt becomes president in 1933. His New Deal doesn't just rebuild, it rewrites capitalism. The New Deal introduces sweeping reforms, creating jobs and stabilizing the economy. Programs like the CC and WPA put millions to work, while new regulations reshape the financial system, ensuring long-term economic stability. He separates commercial banks from investment banks with the Glass-Steagall Act, creates the FDIC, so your money is insured, restoring public confidence. The Securities Act of 1933 regulates Wall Street for the first time. Wall Street doesn't like it, but it survives and adapts. The rules change, so do the players. The financial landscape transforms. J.P. Morgan and Company splits. Small investment firms emerge, bringing new strategies. The SEC is born, now watching every IPO and trade, ensuring transparency. And most importantly, trust is rebuilt. Confidence returns to the market. That trust is the backbone of the modern market, built on the confidence of investors. Every financial crisis since 1987, 2008 and 2020 has followed the same story arc: euphoria, collapse, regulation, and recovery. That's it. Today's Fed, born out of the Great Depression, risk models inspired by 1930s volatility, even crypto regulations being drafted, echo 1933's Securities Act, unemployment lines and economic policies, still haunted by the ghosts of the Great Depression market crashes. They still echo the panic of 1929. History doesn't repeat, it rhymes. 2008 was no accident. It was a remix of 1929. And what happens next depends on whether we remember the lessons. The Great Depression taught us about the dangers of speculation and lack of regulation. Will we heed those lessons, or are we doomed to repeat the past? Here's your bonus. Benjamin Graham, Warren Buffett's mentor, published security analysis in 1934. His strategy? Buy companies trading below their intrinsic value with a margin of safety. It's simple, boring, but it works. Graham's principles still guide modern investors, emphasizing thorough analysis and patience. Even today, a Graham-style portfolio consistently beats the S&P 500 with less risk. Value investing, rooted in the principles of Benjamin Graham, focuses on buying undervalued stocks. Despite being out of fashion, it remains a powerful strategy. This makes it the perfect time to quietly win in the market. The Great Depression isn't just history, it's a haunting reminder of financial fragility. It's the blueprint behind every boom, bust, and bailout we live through today. From the 2008 financial crisis to the COVID-19 economic fallout, its echoes are unmistakable. Understanding the Great Depression helps us navigate today's financial storms. Teacher, don't let the past catch you off guard. Stay informed and vigilant. Like, share, and subscribe to Finance Arcana, because the next crash is already loading. And the smart money, they're already watching. Stay ahead of the curve. Keep your finger on the pulse of the financial markets. Knowledge is power. The Great Depression didn't just affect the United States, it had a global impact, leading to economic downturns in Europe, Asia, and beyond. Countries around the world faced unemployment, poverty, and political instability. The ripple effects of the Great Depression were felt for decades, shaping international relations and economic policies. Technology has transformed financial markets since the Great Depression. From the introduction of computers and electronic trading to the rise of fintech and cryptocurrencies, technology has made markets more efficient but also more complex and interconnected. Understanding the role of technology is crucial for navigating today's financial landscape. As we look to the future, financial markets will continue to evolve. Emerging technologies, changing regulations, and shifting economic dynamics will shape the markets of tomorrow. Staying informed and adaptable will be key to success in this ever-changing environment. The Great Depression offers valuable lessons for personal finance. From the importance of saving and investing wisely to the need for financial resilience, the experiences of the past can guide us in making better financial decisions today. By learning from history, we can build a more secure financial future. Financial crises don't just affect our wallets, they also impact our minds. The stress and uncertainty of economic downturns can lead to anxiety, depression, and other mental health issues. Understanding the psychological impact of financial crises can help us better cope with the challenges they bring. During the Great Depression, many people faced not only financial ruin but also emotional despair. The loss of jobs, homes, and savings created a pervasive sense of hopelessness. Today, we see similar patterns during economic downturns where financial stress translates into mental health struggles. It's essential to recognize the signs of financial stress early on. Feeling overwhelmed, experiencing mood swings, and having difficulty sleeping are just a few indicators. Seeking support from mental health professionals, talking to friends and family, and practicing self-care can make a significant difference. By acknowledging the psychological toll of financial crises, we can take proactive steps to protect our mental well-being. Building a support network, staying informed, and maintaining a balanced perspective are crucial in navigating these challenging times. As we look to the future, let's remember that financial resilience isn't just about numbers, it's also about mental fortitude. By caring for our mental health, we can better withstand the storms of financial uncertainty and emerge stronger on the other side. The role of government in financial markets has evolved since the Great Depression. From regulation and oversight to intervention and stimulus, governments play a crucial role in maintaining market stability and protecting consumers. Understanding this role is essential for navigating the complexities of modern financial markets. During the Great Depression, the lack of regulatory oversight contributed to the market's collapse. In response, the US government introduced significant reforms, such as the Securities Act of 1933 and the establishment of the Securities and Exchange Commission, SEC, in 1934. These measures aim to restore investor confidence by ensuring transparency and fairness in the financial markets. Fast forward to modern times, and the government's role has expanded even further. In periods of economic distress, such as the 2008 financial crisis, governments have intervened with stimulus packages and bailouts to stabilize the economy. These actions, while sometimes controversial, are designed to prevent systemic collapse and protect the broader economy from spiraling into deeper recession. Moreover, central banks play a pivotal role in regulating monetary policy to manage inflation and promote employment. By adjusting interest rates and controlling the money supply, central banks influence economic activity and financial market conditions. However, the relationship between governments and financial markets is not without its challenges. Balancing regulation with innovation, ensuring consumer protection without stifling growth, and managing public debt while providing economic stimulus are complex tasks that require careful consideration and expertise. As investors and consumers, understanding the government's role in financial markets helps us make informed decisions and anticipate potential impacts on our financial well-being. Recognizing the interplay between policy decisions and market dynamics allows us to better navigate the uncertainties of the financial landscape. In conclusion, the government's involvement in financial markets is a critical component of maintaining economic stability and protecting consumers. By staying informed about regulatory changes and policy decisions, we can better understand the forces shaping our financial future and make more resilient investment choices. Thank you for watching The Great Depression and how it still shapes Wall Street today. Stay tuned to our other upcoming episodes of the Hidden History of Money series. Please remember to like, share and subscribe to our Finance Arcana YouTube channel if you like our content.